This week on the podcast, we're going to talk about understanding interest rates and stock investments. So we're going to get into that with Scott this week here on the Wealthy Pilots podcast. Let's go.
We've got some turbulence up ahead. Reach out to the Pilots Planner.
Hey gang, welcome into the podcast. Thanks for hanging out with Scott and I as we talk investing, finance, and retirement with the Pilots Planner. That is Scott Osborn. What's going on, my friend? How you doing this week?
Good to see you, Mark.
Good to see you. Always good. I love this shirt, man. Where's my shirt? I want one.
We're counting on the post office.
Okay. All right. I got one on the way.
Yeah. Oh, yeah. It's on the way.
Nice. Yeah. Can't wait to.
It'll come.
Yeah, rep.
Well, I had to get the black. It's a little bit more slimming.
Yes, exactly. Thank you. As you notice, I wear black all the time. So absolutely got to have the black on, slimming. But I got to rep the show, man. It's good stuff. So, hey, all right, interest rates. Let's talk about this a little bit. We are in mid-August or so when we're doing this. Since the tech issue earlier this month with quite a bit of downfall on the NASDAQ and whatnot, Powell has come back forward and said, okay, maybe they were a little slow to change interest rates, blah, blah, blah. Thinking about doing that now in September. So let's just kind of talk a little bit about interest rates, how they affect various sectors and things of that nature. Give us some details here.
Yeah, I mean, interest rates historically have impacted both the stock market and the bond market, just because it's impacting, ultimately the cost of capital for companies, for private entities, for individuals. And so it's always a very central part of what is going on short term in the market. Now, if it prompted me to do a little bit of research because, we were sharing some information with clients around what's impacting the markets and why they've been dipping recently. And a handful of them had come back and said, hey, at least this will be a good motivator for the Fed to cut rates. And then we'll see the stock market start to go, on a tear again. And it led me to really want to get out and get a little bit of education out there around, historically, when the rates get cut, it is helpful for both stocks and bonds. You see bonds respond favorably because, the bonds that you hold at a higher rate are now worth a little bit more to other investors. And then again, for the stock market, a lot of the companies out there should expect a higher return on capital because the cost of capital is lower. And so it can be a really good stimulus for the economy. However, what we need to be cautious of is, again, almost everything you hear me talk about, trying to make short-term investment decisions can be a fool's errand, I'll say. And so, here's one of the most interesting statistics I found that has been like blowing people's minds. It's like since the year 2000, so last 24 years, anytime the Fed's cut rates, there's been a period between 200 and 300 days where the market is down. And you can see like back in the 80s and 90s, all rate cuts had positive impacts on the stock market returns. 3 months, 6 month, 9 month, 12 month positive. And then in the 70s, it was a mixed bag. I mean, in 1973, and if we can, maybe let's try to get this graphic up for the folks too.
Yeah, we'll throw that up there for them. Yeah,
in 1973, the 12-month return after rate cuts started, the market was down 30%. So that flies in the face of all the traditional wisdom that we have. And so
I was going to say, and we just experienced the same thing, right? So we obviously experienced inflation at the rates we haven't seen since the 70s here in the early 2020s. Oh, God, that's so weird to say. But we experienced some of that, and typically, right, interest rates have an adverse relationship with the bond market. I was always taught when rates are high, bonds die. When rates are low, bonds grow, right? And so obviously the rate hikes, of the last year and a half really, put the kibosh on bonds being an alternative that people were looking at.
Yeah. And so, I mean, the fixed income portion of it too, that's where a lot of times we don't like bond funds. For our folks that are getting closer to retirement, I don't mind. I'm not anti-bond, but like we want to buy a bond that's going to pay you a specific rate. You bring in a lot of interest rate risk when we buy a fund for somebody. And so that's where, really, if you're getting kind of inside of 10 years of your retirement, it's pretty vital to be understanding what you own because, the risks that are involved can really have a much more significant impact on you. If you just own the Vanguard bond fund, you got hammered the last couple of years. But if you owned individual bonds that were paying you maybe 3 to 4%, you didn't. maybe the value of those bonds on paper went down, but you're going to get that money back. In the bond fund, you're not. And so that's where it can be a really touchy issue with this interest rate risk coming in. So, but again, if we look more on the stock side, historically, again, lower rates are good for economic stimulus, but that can still spook the market sometimes too, because again, if you look back in 73, where 12 months later, the stock market was down, the S&P 500 is down 30%, that's really because the market can see, hey, if we're cutting rates, we're probably heading for some sort of recession. And so the Fed's trying to stimulate the economy. And so that can spook investors too. And so again, it's not just a cut and dry case that low rates equal high stock market returns. And it's definitely not been the case short term. Again, pretty consistent in the 80s and 90s that was the case. But again, since 2000, you look back at 2001, 12 months after rate cuts start, we're down 10%. 2007, we were down 21%. And then in 2019, it was positive. But it's a mixed bag. And so there's no guarantee just because we cut rates that short term the market's going to be up. And so that's something that we want to be conscious of, and that we're not falling in love with our investment plan here, and just knowing that, hey, it might go up, it might go down. I'm just going to keep buying because I know I'm buying great shares of great companies, and we'll be able to build a good plan based off of what I own.
Well, I think that's where the investing side comes back into play in a more holistic plan, because obviously cutting the rates is designed to stimulate the economy, which hopefully then would stimulate jobs, which stimulates growth, which makes those companies more successful. So then in the end, right, that's kind of the gamble that you're playing. And let's be honest, I mean, stock market, using any investment is gambling. I mean, to a degree, that's what it all is. And that's why you need to be diversified and having a lot of different things going on inside your portfolio other than just one or two things, because you wouldn't just you wouldn't go to Vegas and just throw all your money on the roulette table. Now, you might, but it's probably not the smartest move, right? So you want to make sure you've got that broadly diversified, well-structured plan.
Yeah. And ultimately, I think, this is really important for, the two big audiences we work with. I mean, one, for our younger pilots, it's important to also almost say like, hey, if you want to grow your money long-term, stay aggressive. We want to keep buying the market. This is not investment advice for you specifically. Obviously you got to hop on the counter or look at your specific plan, but it's not a bad thing to stay aggressive long-term. And then for our folks that are like less than 10 years out from retirement, especially less than 5 years out from retirement, this is a great time to go build out the fixed income portion of your portfolio, because we can get stuff at still some pretty good rates right now and lock those rates in. You can lock in some bonds that are going to pay you 5 to 10%. I'm sorry, 5 to 6% for the next 5 to 10 years, and really get that safe bucket built out where now everything you have in the market, you're not really worried about, because 10 years from now, it's probably not going to matter that much.
Yeah, that's a good point as well, because so many people got excited finally seeing the banks were actually doing something decent. They're like, well, safe money, maybe I can get a CD, which has typically been certificates of disappointment the last number of years.
Right.
But the banks were offering some better rates. But if you really look at that, sometimes if you go on their website, different banks, it was like short term, maybe 18 months they were offering 5% because the interest rates were up. But anything longer than that, they were not offering those higher rates because they expected to come down as well. So
Yep, for sure.
Is your 401k working as hard as you are? Let's find out at thepilotsplanner.com to get started with your free full thrust 401k toolkit. Come see what a good financial co-pilot can do to help make sure your retirement is ready to take flight. Visit us at thepilotsplanner.com. That's thepilotsplanner.com.
So any final thoughts on the interest rates in our pilots and in just investing in general? And to your point, we talk in generalities. We're going to do this podcast. We're going to be sharing a lot of information, but you always want to back that up with, an actual strategy for yourself. Don't just take something you hear from our show or any other and run wild with it, right? Make sure you're sitting down and having a chat.
Yeah, I mean, I think closing thoughts is really like, it comes back to just having a plan and sticking to it. So, I mean, I know for me, I'm expecting rates to come down. I'm expecting a short-term downturn in the market where hopefully we can take some of the money we got on the sidelines and buy that dip and get it to grow long-term. And then for our folks getting closer to retirement, man, lock in some of those great rates right now and build out that fixed income portion of your early retirement years now while the rates are great, because they're not going to last forever.
Absolutely. There you go. All right, folks. Well, what do you do if you need some help? You reach out to Scott, get onto his calendar at thepilotsplanner.com. We've got that on the screen if you've been watching us and checking us out on YouTube, thepilotsplanner.com. You can also just find the information in the show notes description of whatever podcasting platform you like to use, Apple, Spotify, YouTube. Don't forget to subscribe to us on whatever channel you like using, whatever platform you like using, and get on his calendar, have a conversation with him, and get started today. You can reach out to him. Lots of different things you can check out and do. And of course, you just, take some action for yourself. You want a little satisfaction? Got to take a little action. So we'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn, the Pilot's Planner. Thank you, my friend. We'll catch you later.
Cheers.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.